the moves in the 30-year in recent days, how should we interpret that? And specifically the fact that it kind of touched that nearly 5% level, and now it's pulled back about 10 basis points.
Well, a couple of things. First, 5%, in my view, is a great opportunity to add long bonds. It is a wonderful place because, remember, if you look historically, the yield between the 2-year and the 30-year, whether it's in core Europe, whether it's in the U.S., is plus or minus around the 20-year average. So in other words, there's really not an extraordinary anomaly going on. What is very interesting is, like every other cycle, it is correct that the short end comes down first, and that leads the long bond down lower in the future. And that's just normal with a cutting cycle, which is what we're still in. So that's number one. Number two is what you'll notice is what's really been holding up the long end right now has been higher real rates. And again, the higher real rates, in our view, is just a function of the uncertainty around the tariffs. Sooner or later, that's going to wash out. The tariffs are going to be coming here. People are going to recognize it's just a big tax and another headwind to growth. And we think that the long end will start catching up with the short end going lower.
Okay, so you think the long end is going to move lower. So I want to go back to something, because you were clearly listening to the show that we heard from Waller yesterday. He basically said he's not sure that the moves to the upside on yields in the 30-year are a sign of economic distress, or at least investors seeing economic distress, because we haven't seen similar moves in the 10-year. Do you agree with that thesis, the fact that the 10-year and the 30-year would move more in lockstep, or at least move in the same direction if this was about economic concerns?
Well, there's no doubt that the spread between the 10-year and 30-year has really gone much wider over the last 6 months or so. And I think that's a reflection of much higher real rates. If you look at the TIPS market, which again is showing us real rates, the highest end, meaning the 30-year TIPS, are very high historically and versus 10-year and 5-year TIPS. So I think that I have a small disagreement with him, which is a lot of that relates to the Trump tariffs, the delays, and where are things going to shake out. But it appears to be shaking out now. And when it does, I think you're going to see the long end start catching up with the shorter end.
All right. I also want to talk to you about global bonds. Looking at the German Bund, it's had some big upside moves, pulling back. Gilts have pulled back as well, but saw some big upside moves. If it's not about economic distress, if you don't agree with that thesis 100%, why are we seeing it globally? Why are we seeing this trend so broadly?
Yeah, I think in general, remember, rates are going to be somewhat similar unless there's different economic cycles going on, or unless there's different inflation rates going on, et cetera. And if you look at core Europe, if you look at the United States, et cetera, we're all kind of in the same pattern, plus or minus. And I think you're going to see overall long rates come down significantly in all of those countries. It's just really Japan that's the outlier. And that's because their inflation is so high, and it's high historically for them, and it's high in general versus the other core Europe, et cetera, around the world. So our view is you're going to see long rates starting to come down quite significantly, especially now that the tariffs seem to be solved, at least for now. And you're going to start seeing the employment numbers shape out.
You're giving us a forecast. I want to go to the action that we're seeing right now. Is there a headline message? I know you got a lot of thoughts and feelings about bonds, but is there one singular message that the bond market's sending us? The recent spike in yields, the pullback, the fact that the 2-year keeps moving lower, the long end keeps moving higher, it seems like. What's the message that bond investors are trying to send us?
I think it's trying to say that the Federal Reserve is behind the curve on cutting rates. I think that is what it's really saying. They need to start cutting rates, because by the time we really see the employment numbers start to crack like we saw with JOLTS, et cetera, it's going to be too late. We will have already destroyed small businesses, and it'll be very difficult to get them back going. Remember, the difference between a 2.7 inflation and a 2.9% inflation is really small for the American people. But ultimately, if it takes really destroying small businesses to get there, it's very difficult to get those businesses back. And I think the market's saying they need to start cutting rates more aggressively now.